In this video, I'm going to talk about 3 accounts that wealthy retirees could use to lower their taxes. By the end, you will know exactly what these accounts are, how they work, and the biggest mistakes people make with them. Because taxes, they're going to hit you no matter what. And it's a matter of how do you plan for them and how do you decide which one is going to be more beneficial. So with that being said, account number 1. The advanced Roth strategy, which is really twofold. So let's dive into really what that means. The first is obviously everyone wants to be able to put money into a Roth because it grows tax-free. The money that you do actually have to pay the taxes in the current year. So you make money, you pay taxes on it, and then you're able to contribute to a Roth IRA. The fact is though, as many individuals find out, is as you make more and more money, you get phased out, meaning you can't actually participate in a Roth anymore. And a lot of people who have high salaries think, I can't participate in a Roth anymore. And so they stop contributing or they stop participating in it. And really is that you actually can, but what you have to do is what's called a backdoor Roth. Really how it works is you're gonna be able to put money into an individual IRA, traditional IRA. You can put the same amount that you put into a Roth, but what you do is once the money goes in, you put it in after tax. So you pay the taxes on it, put it into an IRA, just like you would the Roth. But then what you do is you do a Roth conversion. There is no income limit on a Roth conversion. So as soon as you put the money into the IRA, you could convert it over to a Roth IRA right away with no income limits, no consequences, and it works phenomenally. The big issue where people make a huge mistake is you can't have balances in a traditional IRA, a simple IRA, a SEP IRA. And here's the reason why, is if you have that kind of money sitting in those types of accounts, is that it comes out pro rata, meaning that if you were to put in $5,000, but you already have a $100,000 SEP IRA, well, you can't just pick that $5,000 and move it to the Roth. The rules don't work that way. What you have to do is you take the $5,000 of this $100,000 account, so it's really 5%, right? 5% of the money that you move over is going to be not taxable, right? And so the other 95% is going to be taxed. So now you got taxed twice because you paid taxes on the money you funded that IRA with, and now you're paying money on the conversion. So the best case scenarios for doing a backdoor Roth is you want to have $0 in an IRA, SEP IRA, simple IRA. So make sure you don't have money in there, and then the backdoor Roth can be phenomenal. Now, the second piece to this is that now you might have a large IRA, a large 401k, a large SEP, and this backdoor Roth didn't make sense. But now let's say you're in your 60s and you've retired. Now you have kind of a timetable that is the key piece to doing real Roth conversions, right? This is kind of the best time to be thinking about it because it's before required minimum distributions kick in. Required minimum distributions kick in at 73. If you're born after 1960, it's actually 75. But what that is it's really the government saying, hey, we let you put this money in, we gave you a tax break, it's been able to grow tax deferred. At this age, we now require that we want to get a little piece of our taxes back. And so they'll say a certain amount is going to be taxed on your IRA. And they'll say you have to take it out. And so that's what happens when you hit the required minimum distribution age. So the timetable between when you retire and when you hit that RMD is normally the key years to be thinking about doing Roth conversions, because in theory, you should have very little income or no income because you retired. And so to that point, you should be actually in a lower tax bracket, right? So now's the time to take advantage of moving money from your 401k, your IRAs, and converting them to a Roth. So now they grow tax-free and they won't be subject to required minimum distribution. Roths aren't subject to required minimum distributions. And so it's a phenomenal way to actually take more control of your account and your retirement account by moving it over to those types of accounts. And that's kind of the key time frame that you want to be looking at year in, year out between when you retire and when you hit RMD age. The second account that every wealthy retiree uses is pre-tax savings. That's on your 401ks, your IRAs, and even your cash balance plans. And so these types of accounts are deferred. So you put the money in and it lowers your taxes today. So for high income earners, which is definitely those who kind of in their last 10 years of working, typically are making the most amount of money for their life. So 401k is very traditional. Most people are used to it. You can put away salary deferral money. Company typically will match it. Both of those are going to be able to go into it and they'll be pre-taxed, meaning it lowers your income for this year and you pay less taxes this year. It's going to grow tax deferred, and we're going to have to worry about it later on and might have to look at doing one of those Roth conversions we talked about earlier between when you retire and when you hit RMDH. The other types of accounts, profit sharing or cash balance. If you own a company or have the ability to participate in one of these things, they can be extremely advantageous, because when we get to profit sharing and a cash balance plan, we're not now talking about $20,000, $30,000 that you can put away and lower your taxes. We can be talking about hundreds of thousands of dollars, especially when you get to a cash balance plan. It could be as much as probably $200,000 to maybe $250,000 that you could be putting away into this plan and lower your taxes this year. So if you're one of those people who own a company and maybe put more of your investments into your company, this could be a vehicle that could be extremely advantageous for you, because as you get older, you're able to put more money into these cash balance plans as far as how the equations work, and being able to put away $200,000 per year into retirement is going to add up extremely fast. So it's something that you could definitely take advantage of as long as those circumstances make sense. It then is going to come down to a cash flow question. This is, can you actually afford to save $200,000? But it definitely is going to help you in your tax situation. Account number 3, the HSA, the health savings account, is an extremely powerful account, but a lot of people don't use it the correct way. So let's get into it. The HSA allows you to put away money tax-free. It goes into an account and it can grow tax-free and it can come out tax-free as long as it's used for medical expenses. So here's kind of the trick where people mess up, is they put the money in and it stays in cash and it doesn't grow. The HSA can actually be invested. You can invest the HSA into the stock market. You can invest it so that it grows. So here's kind of a trick that I use, and I have other clients use as well, is that I will tell people, is like, hey, let's build this up so we have an account that we can use in retirement for medical expenses. The HSA can actually cover a lot of medical expenses that Medicare doesn't cover. And so to have an account that you can use can be very advantageous going into the future. So one of the things that you could do is, while you are working, is you cash flow your medical expenses, you end up being able to put money into the HSA, you invest it, and you let it grow, right? So then if you're 55, waiting till 65 to retire, you have 10 years of growth, but that's 10 years of money that you put in pre-taxed, grows tax-free, and then when you use it in retirement, it comes out tax-free as well. So triple tax-free, super, super helpful when it comes to it. But again, it kind of comes down to planning and making sure you're utilizing that account correctly, because if you just left it in cash, yeah, you only took a small piece of that benefit, whereas you could have invested it and made a lot more, and it would have been much more beneficial to you in retirement. Here's the truth. This kind of planning is not something you do alone. It's not something you figure out from YouTube videos. It's not something just a regular financial advisor can just put together for you. This is the kind of work that requires a certified financial planner who actually plays at this level and puts all 3 of these accounts together. If you have real money and are serious about wanting to find a plan not to give it back to the IRS, if you want to build this tax advantage retirement that the wealthy actually live, then click the link in the bio and book a call with me. Completely free, doesn't cost you anything. We'll sit down with you and look at what this actually could mean for you and your actual specific situation. I'm excited to see you there.